What is up, YouTube, and welcome back to yet another Fridge Financials video. In today's video, we are looking at part 2 of the options trading strategies here. If you are new to the channel, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. Hopefully, you guys are going to be enjoying the options trading strategies. It seems like you guys liked it on social media so far, so we're going to keep creating these amazing videos for you. Hopefully, you're able to stick around throughout the whole process here. We're going through all the levels of options trading that you will see on Webull and on Robinhood, because again, you have to be approved for them. So we're going to be kind of going through some more examples, and today's topics focus on 3 strategies, 2 of which I can show you directly on the brokerage. One where we'll just give you an example based off of Investopedia to kind of break it down that way, because I don't have the current position to show that, so kind of break down the numbers for that one as well. So the 3 trades that we're looking at today, the 3 strategies are a straddle, a strangle, and what is called a collar option. And I've never really heard of the collar option, so I had to do a little bit of research and I found out what a collar is. So hopefully I'll be able to explain how that one works. But straddles and strangles are very, very popular. And we're going to talk about what to do, how it works, and kind of go from there. The last video that we covered here, if we take a look at the Fridge Financials channel, again, we're getting closer to 1,000 subscribers, so thank you guys so much for it. And a lot of video views in the last one, which is great. This one we covered selling options and buying just basic level 1 and level 2 options. Just buying calls, selling calls, buying puts, selling puts. That's it. Today, we're kind of going into an advanced level now, because this one does fall under Webull's level 2, straddle, strangle, and a collar. And then under Robinhood, though, it's under level 3. Straddle, strangle, and they don't have collar on here. So it's very interesting how different brokerages explain different strategies here. So those are the 3 we're covering for today. Level 3 on Robinhood, level 2 on Webull, and we're going to kind of break it down from here. So the first thing I want to look at is to show you is an example of what a protective collar option is. Basically, the way you read into it is that it is based for a hedge in this case. So suppose you own 100 shares of stock ABC, bought at originally $80 per share, and it's currently trading at $87 per share. So you've already made, $700 on the 100 shares you've made. You want to temporarily hedge the position since there's been volatility in the overall market. So hedging, if you're brand new to options, hedging basically means you put yourself in a position where you have some money where it protects your portfolio, and it's not guaranteed to protect the entire thing. But say, you're bullish on NVIDIA and you have a lot of shares in NVIDIA, but it might come down a little bit. You might be able to buy a put option. And again, last video we talked about buying a put means you're betting for it to go down. You might buy a put option as a hedge, so that way if NVIDIA does go down, you lose capital in those shares, but you gain some value in your option that you buy. So a hedge is basically there to offset your potential losses in your portfolio. It's a very popular strategy that people do in their investing in the financial world. Hedging is a thing, and so feel free to do some research on hedging. This is one example about how to hedge it here. So you want to buy one put option, again, which is basically protecting your downside, because if the shares go down, the put option becomes worth more. So you're going to buy one put option, which again is worth 100 shares, with a strike price of $77, and you have to pay $3 per share, also known as paying $300. $3 a share times 100 shares means you pay $300. And again, but what it's doing is that you're protecting the downside, because if your shares come down to, 87 or to come down to like 85, $80, this option that you're buying here becomes worth more. So even though your shares lose value, the put option you buy gains value. So it offsets those losses a little bit. Now, what you could also do is you could also sell one call option with a strike price of $97. And again, selling options or writing an option, same idea, is that you're selling an option saying, hey, I bet that my stock won't go to $97. Okay. Selling the option means selling a call means you don't want it to go higher. Buying a call means you do, selling means that you don't. And so basically what you're saying is that I'm going to sell a call option at $97 here, basically hope that the share price doesn't go to 97, and you get paid $4.50 per share times the 100 shares that you own, gives you a premium of $450. So what you're going to be looking at here is actually when you open up this option at the same time here, what you're going to be looking at is the difference. You're paying $3 in premium here. You're getting paid $4.50 here. So the difference you're getting paid per share is $1.50 times 100 shares gives you a premium of $150. And basically what this is doing is that it is hedging either way. Stock goes up, your shares appreciate in value, your put option obviously loses value. Stock goes down, your call option that you sold makes money, your put option that you bought makes money, and your shares lose a little bit of value as well. So it kind of protects you in either direction. So it's very, very a really good strategy to really use and build in your portfolio if you can do a lot of research behind it. Obviously, this is just informational knowledge here. This is not like, here's the go-to strategy. There are different ways of doing this here. They break down the break-evens, the maximum profits, the maximum losses here. As you can see, the max profit is amazing, $1,850, and the max loss is only $150 because, again, of the difference that you're paying here that you're looking at as a result. So you can lose that $1.50 essentially. So that's basically the idea of the collar strategy. You can look more into it as you go. I hate that I don't have 100 shares right now of a stock that I could do it with right now at this moment in time, so I'm not able to do that. But it's just something to keep in mind about as you're going forward in the options game. So if you ever see a collar strategy, it kind of just basically just wraps the stock around two different strike prices, condensing it, containing it, like a collar does, I guess. And then it allows you to basically hedge your potential losses. So it's a really good strategy to look at. That's basically what a collar strategy is. Straddles and strangles are actually a little bit easier to manage, a little bit easier to work with because they just make more sense. So let's take a look at ticker symbol NKE, which is Nike. So Nike stock, as you know, has like Jordans and the athletic wear, and it's very, very popular. And everybody knows Nike, the nice Nike swoosh and all that kind of stuff. Okay. So how this is going to work? So straddles and strangles. So straddles, strangles, however they're very, very similar names, but how these basically work in level 2 for Webull and in level 3 for Robinhood here, as you'll see level 3 here. And again, you need to have a margin account here. So things to keep in mind about, depending on what brokerage you're looking at. Again, make sure you follow their guidelines about how you do it. And we'll do a whole video about margin later on, so you guys know how I can use margin to my advantage. But back to the actual educational video here. So with straddles and strangles here. So the idea behind a straddle and a strangle is that you're basically buying an option in either direction, hoping for a huge move. Okay. The huge moves with individual stocks like Nike, like Nvidia, like Apple, those huge market moves that you usually see, unless there's some breaking news out there, which unless you're an insider, then you wouldn't be able to know when it comes out. Earnings. Straddles and strangles to me are very useful for earnings because earnings either gives you some forward guidance, it makes you be more optimistic and the market could pump the stock, or it could come in awful and it could dump the stock. And what straddles and strangles do is that they focus on basically either direction here. So let's take a look here. Let's take a look at Nike. And the reason why I do Nike is because, believe it or not, Nike has their earnings coming out today after hours. Now, something to keep in mind about with this here is that when you're doing straddles and strangles, you don't usually, it's a really big gamble if you're doing it the day of earnings. Okay, just so you know. Like if you were to do it today, at the time of recording this, before Nike's earnings come out, you're taking a gamble, 100%. But, if you do like a week out, 2 weeks out, it gives you time to see the stock might move. Usually what people say a lot of time with Nike especially, or with not Nike, with Nvidia especially, Nvidia usually seems to have a run into earnings. So if you do a straddle with a run into earnings or a strangle with a run into earnings for Nvidia, you might be able to get that nice profit because it's already running in a certain direction. Nike's been doing absolutely nothing, by the way, for the last week. So last month, kind of just going sideways. So again, 0.35% move has done nothing. Anyways, trade Nike options here. Okay, so as we covered last time, and again, we're going to do options. So let's say you want to go, here's the expiration day we talk about here. We can go till tomorrow and be a super gambling, risky day trader here. We can go a week out if you want to. Maybe, it takes a couple days for the market to truly appreciate the earnings report that comes out, whether it's positive or negative here. So let's go a week out, for example. And say you're being bullish on Nike. You're like, you know what, Fridge? I think Nike will go to 62. It's at 61.17. I'm going to bet it goes to 62. And again, here's your level 1 options idea, where basically as long as Nike goes higher and higher and higher, again, your break even, $62 plus the premium, $64.16. Anything after that is green and profitable. So that's you being bullish. But then you're looking at it, you're like, maybe, I don't know, man. Earnings is a coin flip for a lot of companies. They could have the most amazing guidance possible, and the stock still comes down 5-10%. So, Fridge, what do I do here instead? Well, what happens if I buy a put option at the same strike, like this? This creates what's called a straddle. And what you will notice here is that you bought the same strike price, same expiration date, but one's a call option, one's a put option. And the pros behind this strategy here for a long straddle is that if the stock moves in either direction, so this is your put option right here, this is your call option here, as long as it moves, so for example, break even is 7% and 10% here. So if the stock moves, 10% either direction, you'll be able to make money in either way. That's what this is doing here. So it covers you on both bases. Basically, what you're telling the market is saying, I'm willing to bet that Nike's going to have a huge move. And I don't care what move it is. It doesn't matter to me. You can move in the negatives. It can go positive. It doesn't really matter either way, as long as there's movement. As long as there's some big movement here, then you're going to get some nice profit on this potential options trade for a long straddle. The thing to worry about here is what's called IV crush. These options right here have a little bit more juice to them because the volatility is increased because of earnings. Volatility means how much your stock is going to be moving up and down. Those meme stocks, those, high risk play stocks have higher implied volatility. If you take a look at an option chain, we have what's called implied volatility. The higher this number is, the more of a move they're looking at for you to have in the stock. Which means that that's the result. Since you're looking at a more riskier move in either direction, it's going to pay costing a little bit more. So these premiums, these prices that you are buying are juiced because of an increase in implied volatility. What does that mean? The problem with straddles is two things. You're paying for two options, so it's going to cost you $500 instead of just betting for either the call side 216 or the put side 320. You're paying for both, so it's going to cost you a lot more money in capital. And also, you have a risk of what's called implied volatility crush or IV crush. If Nike's earnings are just okay, and the stock moves like 1%, 2% even, these options dramatically lose value because they're trying to price in that huge movement. And if the stock trades around here, you're down your huddle $500 really quick. It's called an IV crush. So playing earnings is risky in that aspect because of that nature. So that's the idea behind a straddle. Again, straddle, the pros, it covers either direction. Cons is that you're paying for two options instead of one, and you also have a risk of losing a lot more capital because of IV crush. These premiums are juiced up a lot more. For example, if you want to take a look at, say, like tomorrow's option chain here, take a look at the IV for a bought put option here. It's 166% because obviously earnings are today. This one expires tomorrow. So this contract right here has a juicy premium built into it because of the implied volatility, because earnings are coming out. So just things to keep in mind about when you're trading options. When you get close to an earnings date, you're going to see the premiums and the prices cost a little bit more. So keep that in mind when you're buying options or selling options also. Now, the only thing that's different between a straddle and a strangle is actually not a lot. Say you want to bet that, you're going to buy the option. Say, I think Nike goes $62. Break even is $64.16, obviously, because, that plus the share price or plus the strike price plus the price you pay per share gives you the break even for the call side. We're saying, you know what, Fridge? I'm going to also do a put side, but 62, I'm going to go a little bit low. I'm going to say 61. Right now it's at 61.17. It's going to go just a little bit lower to 61 here. This creates what's called a strangle. The difference between a straddle and a strangle is a straddle has the exact same strike price. Take a look. I'm going to get rid of this one. Boom, long straddle. Same strike price, $62, same expiration date, but one's a call, one's a put. A strangle is buying one option as a call side and then buying one below as a put side here, creates what's called a strangle here. Now, what is the difference here? Well, if you take a look at the numbers here. So here is the straddle we just had. It costed $536. The strangle costs only $485. So a strangle, since the strike prices are a little bit farther apart from each other, there's a little bit less price that you have to pay for this option here, because again, take a look at the break even here. The break even for this put was 58.80. This one's 58.31. And again, since your break even's a little bit lower, that means the probability is a little bit lower to happen, to have that option expire in the money. And that means that it's going to cost you a little bit less. The farther down you go in the options chain here, the less likely it is to happen, the lower it will cost. So that's something to keep in mind about. So that's why the strangle is a little bit more of a cost-effective approach. Same thing as a straddle, because again, you're buying two options instead of one call side, one put side. But if you don't have the capital for it, but you still think Nike's going to have a big move to either side, you could make a strangle with cheaper options. So say you want to do like a 65 here, and then so that's what, $4 up, and then you say you want to go $4 down, so 57. So again, this is a long strangle here. You're looking for a huge movement of 10% in either direction, which again, it's good for potential earnings play if they have a great earnings report. And it's only going to cost you $200 instead of the $500. Again, the farther away you are from the share price for your strike that you pick, the less it will cost because the probability is unlikely. So that's kind of things to keep in mind about as you go. And again, pros, it covers both directions. Cons, you're paying for two contracts instead of one. So that is basically the level 2 options that we've covered so far, straddles and strangles, and we did a little bit of a caller one as well. We covered long calls and puts in Webull on the previous video, covered puts and protective puts. Maybe we'll do a little bit later on. I don't really see a lot of people talking about that one as much. And we did cover calls. We did buy rights, which is basically cover calls, and cash puts in the last video. So these were the last video right here. If you want to go back and take a look at it, it'll be linked in this video somewhere. And then we just covered these three right here, straddles, strangles, and collar. And up next is going to be level 3 for Webull, and still staying in level 3 because level 3 for Robinhood, I guess, is just so much longer. Like, look at all this. This is wild. This is all level 3. I don't know why Robinhood couldn't do level 1, 2, and 3 like Webull does, but, hey, Robinhood has $1 billion market cap, and it has billions in market cap, and I have literally like $5 to my name, right? So thank you guys so much for watching today's video. Again, if you made it fun of the video, feel free to like the video, subscribe to the channel, turn on those bell notifications, as always, for all future uploads. Spread the word about Fridge Financials and what we're doing here. And again, there is a lot more than just options here. So if you're watching this video, you're not an options trader, you can look at how we look at macroeconomic data. We can look at different credit cards, net worths, Bitcoin, different stocks to buy into. I have a ChatGPT trading challenge I'm running right now. There's a lot of different things in this content here. It's not just options here. So hopefully you find something that you enjoy. We hope you guys are making money in the market as per usual, as we always say at Fridge Financials here. And as always, I will see you guys in the next video.